So the most common question that I get when I talk to people about investing in the stock market is, what should I invest in? And the last couple weeks, I spent a lot of time talking about tactical allocations and how to take advantage of AI trade. But we spent almost no time discussing what a strategic allocation should actually look like. And in today's video, I'm going to lay out what you should be thinking about in your early career, mid-career, and pre-retirement, about 5 years out from actually retiring, as far as a strategic allocation for your portfolio. So this video is very near and dear to my heart because I actually lobbied for my company to introduce a self-directed 401k option. So a lot of people are going to have the flexibility at my company to start investing in portfolios beyond what just the company is offering. And with that flexibility comes more questions. Most people don't know what the overall plan should be with their portfolio. So I'm going to lay it out for you. And before we get started, let me just say none of this is financial advice. All the portfolios I'm going to show you are just for demonstration purposes only, and you have to evaluate your own risk profile, your own financial goals before you implement any investment plan. And then past results are not indicative of future performance. With all that said, so there's 3 different timelines that you need to be thinking about. So in your early career, the biggest risk that you can be taking is not taking enough risk. So early career, I define as the first 5 years of your career. You should really be considering a moderate to aggressive portfolio. You want to be 100% equities and trying to drive as much growth as possible. You have almost no money in there, and the money that you are putting in there is going to be compounding for over 20 years. So you want that money to compound as aggressively as possible. And then mid-career, I define that from the 5 to 20 plus year time frame. So that mid-career can be different for each person. It really depends on when you're planning on retiring. And then the pre-retirement time frame I define as 5 years out from actually retiring. For actual financial advisors, if you sit down with them, they actually consider you should be taking your foot off the gas around 40. I think that's a little early just based on how much later people are working. If you are taking your foot off the gas at 40 and you're planning to work to your late 60s or even 70s, that's entirely too early to take the risk out of your portfolio, in my personal opinion. You can go with some of these mid-career portfolios and still get substantial amounts of growth. So there's a few themes that you'll see across these portfolios. So I always put a 5 to 10% sleeve of Bitcoin in all of these portfolios. And it's for one key reason: the asymmetric profile of Bitcoin. So if Bitcoin takes off, a lot of people are projecting it to hit over $1 million. That's really great, even if it's only a 5% allocation in your portfolio. But if Bitcoin goes to $0, it doesn't matter that much because it's a 5% allocation to your portfolio. So the fact that it has this ridiculous upside is a nice feature for any portfolio. If it works out, you're glad you have it there. And if it doesn't, you're really not too concerned about it. The other major theme that you'll see is that the return profiles, if you diversify correctly, you can actually get the volatility and the drawdowns less than the market. But the only way that you can get better returns than the market is if you concentrate into a sector or you do leverage. So none of the portfolios that I showed you today use leverage. And that's a concept where imagine if you bought a portfolio and then you borrowed money and you put that additional money into the portfolio. And then you use the gains of all that money to pay off whatever loan you had. So that's one way to do leverage, but they actually have ETF products that provide leverage that will give you 2x or 3x exposure to certain companies, certain indexes, certain sectors of the market. And I didn't use leverage in any of these portfolios. I just used a combination of a little bit of concentration to certain sectors and broad market diversification. I stayed away from leverage in all of these portfolios. And I did not concentrate down into any individual stocks. It is possible to concentrate down into individual stocks, but I did not do it in this portfolio. And some individual stocks have actually very phenomenal risk reward profiles, but it is very difficult to pick winners when you're picking individual stocks. Only 4% of all stocks drive the majority of the gains of the stock market. So the odds are stacked against you to pick winning stocks across the long term. So let's get into looking at what these portfolio allocations actually look like. So I did all of this modeling in Portfolio Visualizer. It's one of my favorite tools. And I'll actually leave some links down below so you can explore these portfolios in Portfolio Visualizer for the early career, mid-career, and pre-retirement timeframes. So the first one we're going to look at is the early career. So like I said, there is no conservative portfolio. So I actually just plugged in what my company 401k account would look like. So these are the best options that my company currently offers in their 401k. And I wanted to contrast that against what would happen if you actually self-directed and built a portfolio of your own. So this back test is from 2017 to 2026. And the first portfolio we're looking at is a completely diversified 100% equity portfolio. So there is a small tech bias in this, but you do have international exposure in this portfolio. So 27.5% is VGT. That's Vanguard's Information Technology ETF. It's kind of like the NASDAQ 100, but it actually is getting superior returns to some of the NASDAQ 100 ETFs. So if you looked at QQQ, VGT would actually be a superior option to QQQ because of the lower expense ratios and the superior return profile. Then we have VT, which is a Vanguard Total World. This is our international exposure. We got our 5% Bitcoin sleeve using GBTC. In practice, I would recommend using FBTC. That's the Fidelity Bitcoin ETF. It has a lower expense ratio than GBTC. The only reason I use GBTC is because you can actually back test further using GBTC over FBTC because the Fidelity Bitcoin ETF is fairly new. Then we have VTSAX. This is a classic. This gives you total stock market exposure. That is a 20% sleeve in there. Then we have some semiconductor exposure with SMH. Semiconductors are everything from your cell phone, computer, all this AI stuff, your car. Semiconductors are literally everywhere. They're not going away, and that market has been experiencing tremendous growth. And then we have XLE. So this is an energy sector ETF. So this is a defensive portion of the portfolio, and it doesn't necessarily have to be the energy sector. Some other considerations would be XLP. That's a consumer staple ETF. It is also defensive, and that's really what you're looking for. Or you could do a quality tilt. So looking for companies that are trading on value, have very sound financial books, aren't very volatile, aren't experiencing a ton of growth, but they're blue chip staples. That would be QUAL. That would be a quality tilt. And any sort of defensive ETF you could plug into this slot. But I'm in the energy sector, so I picked XLE. And that's the diversified equities portfolio. Now, if you wanted to get more aggressive in early career, you could concentrate even heavier into a tech bias. I mean, if you look out over the next 20 years, you can see that tech is going to be driving the market. You may not be able to pick out the individual names that are going to be the top, but you can see that there's artificial intelligence, there's robotics, there's quantum computing, there's self-driving cars, we're launching things into space. We're trying to mine on the moon. All this stuff is tech, 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 tech. So the major driving force in our economy, probably over the next decade or two, is going to be tech related. So this concentrated equities portfolio is trying to take advantage of that idea. So we're 40% VGT. We have a 10% sleeve of Bitcoin here just to take a bit more advantage of that asymmetric profile of Bitcoin. We have 40% allocation to semiconductors, same thing, very tech bias. And then we have our 10% slot, which is some sort of defensive play. And energy is actually correlated with tech. I mean, if you think about AI data centers, they're going to require a lot of energy to build those data centers out. So as AI and those data centers get built out, you can see a boom to the energy sector. So I like the energy sector as my defensive play for this concentrated equity portfolio. So if we look at the actual return profile of all of these, what you will see is that the company 401k, if you start with $10,000, you went from 2017 to 2026, it turns to $41,000. It has about a 16% compounding annual growth rate. It's slightly beating out if you just hold a straight S&P 500 index. And then this diversified equities portfolio and this concentrated equities portfolio are both crushing just holding the S&P 500. So that 10,000 turned to 125,000 with the diversified equities, and this 10,000 turned to 300,000 in the concentrated equities. One's compounding about 30%, and the other one's compounding about 43%. And what's worth noting about this diversified equities portfolio is that its worst year is only minus 14%. That's actually less than if you're holding just straight S&P. And the concentrated equities portfolio, the worst year is minus 26%. So it's slightly more volatile than holding the S&P 500, but the gains are substantially higher. And you can see that we're not just taking risks for the sake of taking risks. If you look at these Sharpe and Sortino ratios, so Sharpe and Sortino ratios are your risk reward ratios. They're showing you how much return you're getting for the amount of risk that you're taking. And the higher the ratio, the better. And you can see that these Sharpe and Sortino ratios are absolutely crushing the company 401k and are absolutely crushing if you just invested in the S&P 500. And as you move from that diversified equities portfolio to the more concentrated equities portfolio, you can see that the benchmark correlation actually went down as well. So all of those are very solid early career portfolios. You can use those kind of ideas and concepts in your own portfolio construction. If you don't like the tech bias, you could sub out the VGT with VOO or VOOG, which is an S&P 500 or an S&P 500 growth ETF. but you get the overall picture. This is how you can build a portfolio and outperform the market with a small amount of concentration without betting the farm and without taking too much risk. So let's move on to the mid-career portfolios. I'm guessing most of you are probably mid-career. I'm firmly in the mid-career category. And these portfolios, just because they're mid-career, does not mean that the gains aren't as strong. So we're stepping through a conservative, a moderate, and aggressive portfolio. And it's a 60-40 mix, a 70-30 mix, and an 80-20 mix. And usually when people are saying 60-40, 70-30, 80-20, that last 40, 30, or 20% is bonds. But I actually strongly dislike bonds. Bonds are very closely correlated with market returns now, but they don't actually get the same return profile as holding equities. So back when people used to suggest bonds and portfolios in the 70s and 80s, there was less correlation between the stock market and bonds. But these days, if interest rates are going up, then bond prices are going down. And if bond prices are going down, that means that equity prices are also going down because companies can not borrow money at those cheaper interest rates. So both of these things are going down at the same time. What you really want is something to hold steady or go up when the stock market goes down. Bonds used to do this, but that's not the relationship they have now. Same thing if interest rates are going down. If interest rates are going down, bond prices are going up. And if interest rates are low, that means companies can borrow money cheaply. That means that they can juice their returns. They can invest more aggressively to build their earnings, and stock prices are going up. So you have these bonds in your portfolio, and they're just going to underperform just holding equities, and they're not actually hedging that much risk. And for that reason, I actually like to use gold for that 40, 30%, or 20% sleeve in these portfolios. So for this first 60-40 portfolio, you can see that I use 40% of it as VGT. It has a tech bias. We have 40% IAU. You could use GLDM. It's a very similar gold ETF. It has a slightly lower expense ratio than IAU. Either one would be good. And then we have our 5% Bitcoin sleeve, like all our other portfolios. We have a 5% semiconductor ETF bias. And then we have our defensive ETF pick, like we had in our previous portfolios, this case XLE. Then we'll go to our 70-30 mix. It's very similar. 35% is VGT, 30% IAU. We bumped up our Bitcoin sleeve very slightly to 7%. We bumped up our semiconductor sleeve very slightly to 18%. And we still have a 10% defensive sleeve. And then 80-20 is more of the same. We bumped down the VGT. We ratcheted up the SMH. We still have our Bitcoin. It's slightly higher at 10. Our gold slightly lower at 20. And our defensive sleeve is still sitting at that 10%. So what does this look like? So the $10,000 investment, no additional contributions. You can see it's compounding at a 30% rate for the 60-40, a 35% rate for the 70-30, and a 41% rate for the 80-20. But if you look at it, the worst year for the 60-40, the worst year for the 70-30 are both less than just holding the S&P 500. And then this 80-20 mix is only about 2% worse than just holding the straight S&P 500. But the return profile is substantially better. And if you look at these Sharpe and Sortino ratios, they actually outperform those early career portfolios. You're going to spend most of your career in this mid-career time frame, and you want to be getting those risk-adjusted returns. You want to grow it as aggressively as possible, looking at your own risk profile. And these portfolios do an excellent job of doing that. And the benchmark correlation is actually extremely low for all three of these portfolios. Gold has a very low correlation with the stock market. Bitcoin has a low correlation with the stock market, and those are all good characteristics when you're trying to diversify a portfolio. And now we get to the pre-retirement portfolios. And I say pre-retirement because it's five years out from retiring. But truthfully, you could use these portfolios anytime you want to take your foot off the gas and actually lock in the gains that you've made across your life. If you've won the game of capitalism and you've made millions and millions of dollars in the stock market, you don't have to keep taking the risk. You only need to get rich one time. And these portfolios are very good at parking your money and letting you sleep easy and not worrying about the volatility in the market. I do not have an aggressive pre-retirement portfolio because the biggest risk that you can take right before retirement is something called a sequence of returns risk. So, sequence of returns risk, very simply, if you are going into retirement and your account balance goes down and then you start pulling money off on that lower account balance, you are locking in those losses. So, to avoid this, you don't really want your account balance to dip very aggressively early in retirement. So you build out portfolios to mitigate that sequence of returns risk. So you don't run out of money by locking in those early losses in retirement. And these portfolios are perfect for protecting against that risk. So there's no aggressive portfolio. So I put the company 401k portfolio here to contrast against these pre-retirement portfolios. And the first one I want to show you is actually called a risk parity portfolio. So essentially what you're trying to do is you're trying to balance the risk across all the assets in your portfolio. And this is actually one of the first portfolios I'm going to show you that introduces cash and managed futures ETFs. So we have a 35% allocation to gold. We have a 5% Bitcoin sleeve still. We actually have 15% in cash. We have 10% just in broad S&P 500 index fund. You could sub that VOO out for VT-SAX, which is the total stock market if you wanted. Then we have this managed futures ETF. So to zoom in on that, what that managed future ETF is it actually has a negative correlation with the stock market. And when the stock market goes down, this managed future ETF is going to go up. It is a perfect hedge in a portfolio. But most people are not comfortable with holding more than about 10% because as the market goes up, most of the time, these managed futures ETFs are very slightly negative or they're holding at the same value. Some of them put out dividends. So this DBMF has a 5% dividend. So even when it's holding steady, it's kind of acting like cash in your portfolio, but it really shines in a market downturn. If you look at its performance in 2022, in the last sharp market downturn, this DBMF went up over 20%. And that's exactly what you want in something that's hedging risk in your portfolio. Then we have a defensive sleeve. I use XLU. This is different than the XLE. This one actually spits out more dividends and is more stable than the XLE. That's something that you'd be looking for in a portfolio that you're trying to manage risk in. So it's still utilities, but it's a smoother utility. And like I said, you could use a consumer staple here. You could use a quality tilt ETF here. And then the last one is still a bit of that semiconductor ETF, a little bit of growth in there to juice the returns just a little bit. And then the moderate portfolio here is a balanced portfolio. So we've got 50% gold. We still have our 5% tilt to Bitcoin. We have 7.5 to the S&P 500. It could be VT-SAX, like I said. We have our 10% managed futures sleeve to help manage risk. Then we have 7.5% going to utilities. Once again, it could be any of your defensive ETF picks. And then we actually have 20% going to semiconductors to get a bit more growth. If you're comfortable with a bit more risk in your pre-retirement portfolio. Now, these portfolios I am very pleased with because if you look at this risk parity portfolio, you can see that its worst year is only minus 8.3%, which is less than half the volatility that you get from holding an S&P 500 index fund. But the annualized returns are slightly better than the S&P 500. You have 21% there compared to about 15.8% in the S&P 500. And this balanced portfolio very slightly outperforms that. It has a 25% annual compounding growth rate, which slightly beats the S&P 500's 15.87. And both of these portfolios have very strong Sharpe and Sortino ratios. They're both hovering right around 1.5 for their Sharpe and around 3 for their Sortino ratio. So these are very good portfolios to park your money right before retirement. You're not really missing out on that much growth, and you're not really taking that much risk. Phenomenal portfolios, and honestly, I've seen people carry portfolios like this into retirement and be very, very successful. We want to talk about what to do in actual retirement very briefly. I'm not going to show you any portfolios for this. I actually did an entire video on different retirement portfolios that you can build, what are the pluses and minuses, how you set all this stuff up. But essentially in retirement, you want to mitigate that sequence of returns risk. So in retirement, there's like 3 common strategies that people use. So a bucket strategy, which is you want some cash, you want some bonds, or in this case, I like gold instead of bonds, and then you want equities. So the thought process is early on when you are at risk of that sequence of returns, you use the cash. And you should be able to wait it out long enough that the equities are growing and not going down. And then if you run out of the cash, then you move on to the bonds. They're less volatile. They have lower expected returns. And that whole time, your equities should be growing. This is the most conservative way to manage that sequence of returns risk. And it's going to have the lowest return profile of the 3 portfolio options. Then you have your moderate portfolio, which is a 60-40 stock bond glide path. And like I said, I like gold instead of bonds. So you can do 60-40 gold. And the idea here is you're 60-40 early in retirement. You get through those first 3 to 5 years, and then you slowly glide path back out to a 100% equity portfolio. You have good returns that whole time, and it helps manage that sequence of returns risk, and you can slowly glide back out to a 100% equity portfolio and manage the risk of inflation across your 30+ year retirement. And then newer research has shown that you can actually be aggressive in retirement if you want. But there is one key distinction. So that bucket portfolio and that 60/40 glide path portfolio, they both assume fixed withdrawals. You're withdrawing somewhere around 4 to 5% every single year. But if you actually have a large enough nest egg, or the risk profile or risk tolerance based on having more income coming in, or your spouse having income coming in, you can actually be 100% equities all the way through retirement, and you just flex up and down your spending. If the market is doing well, you can pull off a little bit more. And if the market is going down, you pull off a little bit less. You set up some guardrails so you know at what point you can pull off more or pull off less. I did a whole video on this. Like I said, there's Guyton cleaner guardrails, which are easy to calculate. And then there's risk adjusted guardrails, where you're actually looking at the probability of success of your overall retirement plan. If you sit down with a financial advisor, or if you use a tool like Bolden, and can actually help you figure out these guardrails for yourself. And that's the overall plan for managing your whole career strategic allocation. So what are the big takeaways from this? You need to have a plan. You have to know what your plan is going to be across your career. These are portfolio ideas that you can use to build out the plan for yourself. And honestly, you really only have to look at it a couple times across your entire working career. That transition from early to mid, and that transition from mid to pre-retirement. 3 transitions, maybe you might transition from conservative to moderate to aggressive, or aggressive to moderate to conservative. Life changes, you change. And you might want to take your foot off the gas, but at least you know what that looks like. You have some sort of framework to think through, okay, at this point in my life, with kids heading off to college and this nest egg saved from everything I did in my early 20s, I want to take my foot off the gas. You know how to do that. Or say you hit it big with one of these asymmetric investments in Bitcoin or whatever, and you're like, I just want to park this. You know how to do that as well. And implied in all of these different portfolio ideas is that every single year you're going to rebalance back to these percentages. You're not going to let the semiconductors run and take over your whole account. Every single year you're going to have to rebalance it back to that portfolio mix you specify. Some brokerages let you automatically do this, and other brokerages, you're actually going to have to go in and manually adjust it about once a year. That's pretty low maintenance for something that can make you millions and millions of dollars. And if today's video was helpful to you, if it gave you some ideas about how you could build out your strategic allocation, and how it can work with those tactical allocations I showed you in the other videos, like the video, subscribe to the channel, because I'm going to be trying to make you 1% better every day. Thanks for tuning in, and I'll catch you next time.
Understand the market, keep your vision on the prize, building up the wealth right in front of your eyes. Talk Higgins, yeah, we keep it moving. Talk Higgins, watch the wealth improving. Markets and the money, making sense of the math, helping you navigate the financial path. Talk Higgins, subscribe for the vision. Stay smart, stay invested. We out.